This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
Hi, thanks for joining us. My name is Bruce Norris, and today our special guest is Jeffrey Snider. Jeff is the Chief Investment Strategist at Alhambra Investment Partners. Jeff directs the day-to-day investment processes and spearheads the investment research efforts while providing close contact to Alhambra's client base. Jeff joined Atlantic Capital Management, Inc. in Buffalo, New York as an intern while completing studies at Canisius College. After graduating in 1996 with a bachelor's degree in finance, Jeff took over the operations of that firm while adding to the portfolio management and stock research process. In 2000, Jeff moved to West Palm Beach to join Tom Nolan with Atlantic Capital Management of Florida, Inc. During the early part of 2000, he began to develop research capability that ACM is known for. As part of the portfolio management team, Jeff was an integral part in growing ACM and building the comprehensive research management services and then turning that investment research into outstanding investment performance. As part of the research effort, Jeff authored and published numerous in-depth reports that ran contrary to established opinion. In the nearly year and a half run up to the panic in 2008, Jeff analyzed and reported on the deteriorating state of the economy and markets. In early 2009, while conventional wisdom focused on near perpetual gloom, his next series of reports were providing insight into formative ending process of the economic contraction and a comprehensive view of factors that were leading to the market's resurrection. In 2012, after the merger between ACM and Alhambra Investment Partners, Jeff came on board Alhambra as Chief Investment Strategist. And currently you can read what Jeff writes at Real Clear Market, Zero Hedge, Mini Anvil, and Yahoo Finance. Jeff, welcome to our show. I appreciate you taking the time to do this.
Oh, my pleasure, Bruce. Thanks for having me on and inviting me.
You know, what's really interesting is that you have really intelligent people, well-intentioned on both sides of the inflation and deflation answer. And so it's going to be interesting and have a great talk with you today. I'm always interested in timelines when people get into things. So, I mean, you're not that old, but you've seen a lot. You know, you get into the stock market game basically, and a couple of years later, you run into 2000 and then run into 2008. And if you're in charge of other people's money, that's not a fun period.
Yeah, it would have been better to start earlier in the early 80s. Then you could have the full bull market and then retire somewhere around 99 or so, right? Because that was, as exciting as it was to watch stocks go up, that was boring, right? There was nothing really going on. Everything was great. You're right. It's almost like the curse, the old parable. May you live in interesting times. I don't think many people in this business, several generations have passed since we've had such interesting times, and it's one thing after another, it seems, we can't seem to get out of this mess or get out of the situation.
Yeah, and not little things, especially when you're in charge of other people's money. If you do that right, it weighs heavier than your own. And
yeah, so, it's almost ironic, right? Because back in the 90s, when everything, asset bubble, the stocks, everything was going up, people really didn't worry all that much. It's only since they've seen the downside kind of repeat itself, all of a sudden it's like, wait a minute, we need to be a little more cautious here. When I was first starting out, clients were just, hey, whatever you guys do, we're great. It's all good. But now, clients and people who are investing their own money, even if they have a professional on the side, they're asking more questions. They want more answers. They want more direct answers about, what is really going on here? I mean, what is it really what we kind of feel and what we see, or is there more to the story?
What's the one consistent investment since you've been around that's been profitable?
I don't think there is one. And I don't, for us, it's, we live in a dynamic world. Things are always changing. I'm always talking about the euro-dollar monetary system, and that has changed radically over the last 10 years or so. So a consistent, where do you go? What's the one place you can go to? I think it's, it might be different under different time periods or different particular conditions.
in the era that you've been involved in, I was thinking you'd probably say bonds. Not something.
Well, yeah, since since around 2011 and 12, yeah, that's been a consistent, as consistent maybe as there could have been. But even that, there's some volatility involved there. You know, you get 2017, 2018 when rates started to rise. I mean, that was not a pleasant time to be saying, "Hey, hold on here, bonds are probably going to be a good investment over the longer run." So even the bond market over the last decade, which has had a really good run, it's not a straight line. It's not, perfectly awesome all the time. There's volatility in that too.
That's the hardest thing about being in charge of other people's money. We have a pretty boring setup where we are lenders, hard money lenders that lend to investors that flip houses. And like you, I try to look forward and say, okay, wow, this is going to get bad. So, we basically pulled out of lending for a couple of years, say starting 2006, and we're sitting on the sideline and avoided a lot of that damage. So our client base generally doesn't enjoy volatility. And I'm along with that. It's interesting about investing. Most of my investments are real estate. And what I realized, I tried stocks one time, perfect timing as far as being terrible. It was, my father was investing in penny stocks and I knew he didn't know anything about them. So kind of to protect him, I got into studying penny stocks for a little while, and I invested at about $250,000 at the end of 2019. And that turned into 800 grand in about 40 days. And I just thought, man, I'm good at this too. That's great. and a month later, it turned into 100 grand. Now, what I understood about myself, though, what was interesting is I didn't like seeing value of even to go up every day, because it's, they don't have an appraisal on your property every day. You own it. But when you have stocks and all that stuff, you can see what it's worth every day. And, you're in charge of clients that may be, not geared to look at, bad news and probably call you up a lot and go, oh my God, what's going on?
Yeah, there is that sort of, it's almost like short-termism, right?
Yeah.
Because you get caught up in the trend and you see, oh, that's going up and going up and going up, and you don't realize the implications or the potential implications of it, or you may not be thinking too far ahead. Plus, I think for you as well as me, when you see something like that, short-term price rises, that's a good thing. You don't want the opposite, obviously, but if it goes up far and fast, that it's probably not real. You're looking at something very different. Whereas, the average person on the street may not think that way. They might think, well, it goes up and it stays up forever. But when you see, asset classes and asset prices go up and just fly ahead, you kind of have that nagging feeling that there's something going on here that we need to pay attention to, because that's not how it's supposed to work. And I use that term loosely because supposed to work is, can be many different things, but, sustainable investment trends are not those that are going to shoot way up and then burn themselves out. Sustainable investment trends, you're looking more for incremental, solid, fundamental, value-based kind of factors and fundamentals.
What's the concern about having high inflation?
There's any number of
implications of that.
Well, inflation, I think for the average person, it's the most painful thing, because, you got to eat, you got to put gas in your car, and you see prices of those go up. And, usually in an inflationary period, your wages are not, and your pay is not keeping up with the cost of living. So every day you're reminded that you're falling further and further behind. So for the general public and the vast majority of the economic population, inflation is sort of a visible, visceral reminder things are going the wrong way. And that can play out in any number of ways, especially if it continues over time. It leads to political, social instability and things like that. Whereas the deflationary case, in many ways in economics, is much worse, but most people don't realize it. And so there's sort of that disconnect. Whereas inflation, you really can't get away from it. And I think we have to be careful when we talk about inflation. What are we really talking about? Because when you use that term inflation, it's different to different people. And what standard economics, the textbook says, is that inflation is a sustained increase in consumer prices. So it's not consumer price in a broad-based consumer price. It's not just a narrow set of consumer prices that go up for a short period of time and then sort of normalize. It's where almost everything, the price of everything that a consumer uses or buys, goes up, and it continues to go up month after month after month, year after year. That's really what inflation is.
Who benefits from inflation?
Well, if you're someone who owes debt, obviously you want to pay that debt back in a deflated currency. So if you can borrow money ahead of an inflationary curve, knowing that the prices are going to be devalued, or your prices are going to go up over the future, and the currency that you're going to pay back is devalued in the future, you're pretty much the only beneficiary. So you're making everybody else suffer for, I mean, it's not like you're doing it, but right. you're taking advantage of the system inflicting a lot of pain on pretty much everyone else.
My experience with inflation, when I was a young adult, got married very young, and I owned a home from, let's say, first time 73. And all of a sudden prices of real estate in California took off, paid 21 grand for the house. I sold it, and I had a $10,000 check at the end of that escrow made out to my name, which just was very impressive to me. And I thought, wow, what if I own 3 of these things? Right. And so that's what I did. I divided that up, and I put down 3 down payments and bought. So inflation for the asset that I held was actually a very big deal, because at the end of that little cycle, I'm 28 years old, sold 2 of the houses and paid off a free and clear house. Now, you had a 30-year mortgage and it was gone in 5 years. And so, I was looking at, I was on the right side of inflation as far as the assets that I held. So if you hold some assets, so what assets benefit when inflation occurs?
Well, real estate and commodities, things that are tied to the nominal economy, those are obviously 2 of the main ones. Gold, under certain situations, gold was obviously a good hedge during the 1970s, once it was allowed to float, got away from the 2-tier prices of the late 60s. So that was another good inflation hedge. And you can get more sophisticated inflation strategies where you're playing the yield curve, steepening, and things like that. There are various number of ways in which you can invest in an inflationary environment and not come out too bad, and maybe even come out ahead.
Okay. When I wrote a report the first time, I got access to a lot of information that was done for contractors. Cal Poly Pomona had a construction report. And during the inflation years of the 70s, they actually took apart what it took to build a home constantly, for the next decade, parts and labor. And what was really interesting, after being able to look at all that information, I realized as a real estate owner, basically what I own is a basket of commodities.
Right.
So when prices of all that stuff go up, if I have a rental, my lumber goes up, my concrete goes up. So I thought, well, okay, that's a pretty good inflation hedge. And
absolutely.
Yeah.
And also the, got to factor in the cost of labor that puts all those commodities together. So you want to be hedged against that as well. But yeah, by and large, commodities do very well during inflationary periods, as you would expect, because some people correctly identify an inflationary period with sort of a devaluation of the currency, US dollar in this case, which is a little bit tricky in the 21st century. But still, what you're looking at is if the value of the dollar, more generally speaking, declines, you would expect commodity prices to rise to offset that. So either way you look at it, there's definitely a historical as well as intuitive correlation between those 2 things: rising inflation, rising commodity prices.
So short term, is there concern about inflation that's realistic?
As far, you mean obviously people are talking about nothing else other than inflation. Yeah. The CPIs are the highest they've been in 30 years, and some components the highest in 40 years. So obviously, inflation discussions and conversations, it's the primary topic everyone's talking about. The question is whether or not it's actual inflation, or are we seeing something else? And when we get back to the definition of inflation, broad, sustained increases in consumer prices. Well, what's behind that? What is it that's causing this textbook form of inflation? And it's always and everywhere a monetary phenomenon. So if you don't see the monetary phenomenon behind it, then you would see this consumer price, or whatever you want to call it. I call it a price deviation, transitory, if you want to use Jay Powell's language. What's going on in the CPI doesn't have the monetary flavor behind it. So you start to be a little bit skeptical about whether or not it actually continues beyond these short-term factors that are driving it, and balances. Essentially a supply shock. This is nothing more than a historical supply shock.
When you look at the bond yield, is the bond world concerned about inflation?
Not at all. that's one that should be ringing alarm bells, because the bond market has been a very good predictor of inflation. We need to only go back a couple of years. Let's go back to 2018 when Jay Powell comes into office. What did he say? He wasn't talking about transitory back then, except he was talking about transitory deflation. He said inflation's coming. The Fed is going to have to be hawkish. We're going to have to raise rates more aggressively in 2019, where the bond market, the bond yield curve started to flatten out, really flatten out, then inverted, which was calling his bluff, which was the bond market basically saying there is no inflation coming. And by and large, you're going to end up cutting rates because deflationary pressures are becoming too big to ignore, which is exactly what happened. And that's just a repeat of the cycle. We went through this in 2014 and 2015. When Janet Yellen came into office in 2014, said, "All right, best jobs market in a decade. Look at that unemployment rate drop. We're going to have to start raising rates." And bond yields were falling and saying, no, you're not going to have to start raising rate because there is no inflationary pressures building up. And in fact, that's what happened too. The Fed did one rate increase in December of 2015. And they had to wait an entire year to do the second one because the bond market got that one right too. Go back to 2011, same thing. In fact, 2011 reminds me a lot of what's going on today, because in 2011, you had high CPI rates, you had everybody talking about inflation, commodity prices, oil, all of that stuff was in the general conversation. And the bond market said, nope, not happening here either. Transitory. It's not, there isn't the economics, there isn't the money flow throughout the global economy that would sustain what we're seeing in the short run. And of course, that's exactly what happened as well. So if the bond market is saying, I'm not really worried about inflation, I'm far more worried about disinflation or deflation, that's something you got to pay attention to.
Yeah, that is really interesting. In 2017, we wrote a report that had this title, 2% interest rates and 40 trillion in debt. And at the time I wrote that, you know, I'm a real estate investor, to saying we're going to have 2% mortgage rates. Mortgage rates start with a 2. And of course, at that time, that was, okay, you're out of your brain. But and this is one of the questions that I wanted to ask you. It seems like all of these efforts, rather than trying to prevent inflation, are really trying to prevent deflation.
Absolutely. Yeah. And from the Fed's perspective and from modern economic perspective, the worst case scenario is deflation. And this goes back to John Maynard Keynes. There's all sorts, I mean, the Great Depression was obviously a good example of that, where it's pretty well known that deflation is the worst case. So you can't blame the Fed for at least attempting to fight against deflation, because first of all, number one, the deflationary case or the deflation underlying baseline has been the case, or the underlying baseline, going back to August of 2007. So the reason they're trying to fight against deflation is because that's what's going on. So you can understand why they're doing that. Now, the problem is the techniques and the tactics they use, quantitative easing and all these other things, are totally misunderstood, and they're ineffective. They don't create the kind of inflationary environment that would be conducive to a broad-based, sustained increase in consumer prices. It's a bunch of smoke and mirrors that people have bought into because, you know, quite sympathetically, they've been told to buy into this stuff for generations, for decades now. All we hear about is, don't fight the Fed. The Fed has the printing press, and if they unleash it, God forbid, there's going to be a tidal wave of inflation. Except there hasn't been. You know, the Fed's going to destroy the dollar with quantitative easing. You know, the dollar's higher, not lower. And so, you know, a decade after we've hearing all of these things, you have to start asking yourself, what is really going on here? The bond market continues to picture and price more and more deflation, while the Fed continues to repeat these quantitative easings, which everybody says is money printing. It's a tidal wave of money, yet we never get the inflationary burst, aside from temporary transitory impacts in the CPI and whatnot, you know, like 2011, and I think what we're seeing now. So there's this tremendous disconnect between what we're taught and led to believe the Fed does and what it actually does, which is something completely different. Okay.
Well, let's talk about the 70s. That we did have inflation. So there was simultaneous things going on. In 44, we had the Bretton Woods system set up. In 71, I think it was, Nixon ended that officially. And,
yeah, but it's important to note, you know, where did the great inflation come from? It was a monetary phenomenon, and in large part, it came from a Fed, an ineffective central banking scheme, but also an unleashing of monetary and banking evolution that actually undercut the Bretton Woods system long before August of 1971. So you have, the formation of the London Gold Pool in November of 1961, which was, 10 years before that, basically the system had already broken down. And one of the reasons why was Triffin's paradox, which was the fact that, the way the Bretton Woods scheme was set up was that we had a national currency backed by national reserves as a global reserve currency. In a global reserve currency, you have to have enough currency flowing around the rest of the world in order to make a global reserve system work. But that created this tension between, if you have too much, if you have all this currency floating around outside the United States, but it's tied to a limited supply of national reserves, it's never going to work, because eventually those national reserves are going to be converted by all these dollars floating around the world that the world needs floating around the world. So that's what's Triffin's paradox, which is essentially, you can't have a national currency backed by national reserves as a global reserve. And eventually that ended up failing in, November 1961. But what actually replaced it? It wasn't a dollar system. It was this global euro dollar system, which was a bank-centered system that arose in the 1950s and began absorbing the roles of the global reserve currency that couldn't be provided by Bretton Woods gold exchange. So by the time Nixon closed the gold window in August 1971, the liquidity, the adjustment, even the confidence functions of the global reserve currency had already been overtaken by this basically unregulated, unlimited, reserveless shadow money system. And you wonder where this, the great inflation of the late 60s and 70s came from. It came from an unregulated, reserveless, essentially limited monetary system that grew outside the United States, outside the Federal Reserve's purview, that just created vast amounts of, not money. We're not talking about physical currency here. We're talking about virtual ledger type money, a unit of money of account, it's called. And so you had this wave of monetary evolution just washing over all parts of the global economy, which created the inflationary background that became the great inflation of the 70s. So again, consumer inflation, the monetary environment for it.
Is it in the history of being a reserve currency, is the reserve currency usually backed by gold, or was that unusual?
No, there is no one way to do it. And really, there hasn't been a single global reserve currency. Usually there's currency blocks. For example, in the late 19th century, there was the biggest currency block was the English pound sterling.
Right.
And it was obviously backed by gold at certain times. I mean, obviously the English went off the gold standard, typically when they needed to fight a war or something like that. But yeah, there was a historic tie between currency and gold for very obvious reasons, because once you go off of some kind of external or exogenous standard, governments and the powers that be have a tendency to want to push the boundaries as far as they possibly can. And in some cases, you think Weimar Germany, they go way, way, way too far and end up wrecking the system.
Okay. What are the benefits of being the country that's viewed as the reserve currency of the world?
Well, I'm not sure there are any. And that's a common misconception too. When you talk about the dollar denomination being the global reserve standard with the functions undertaken by a Eurodollar system, it kind of sounds like we have an enormous privilege. That's something we don't want to give up. For example, the world prices oil mostly in U.S. dollars. That's the common term you hear thrown around is petrodollar, which is kind of a misnomer and kind of a misunderstood process too. But by and large, it is kind of a burden. It's really, when you get back to Triffin's paradox and what he was really saying is that have a global reserve currency linked to a national system it's going to cause natural tensions and problems. And in one way, that's why the Eurodollar, this bank-centered private offshore system, was sort of an elegant solution to it, because it essentially allowed the national authorities in the US to wash their hands of it. They say, we just focus on the domestic system, or domestic banking system. All the stuff that goes on outside the US, we don't care. They even came up with a term for it. It's called benign neglect, where they said, this dollar stuff that's around the rest of the world, not our job. We're just going to focus on the US. It doesn't matter that these are called US dollars all around the world. It's not our problem. And so it's solved for US authorities that national issue, where they can just wash their hands of all these dollars outside the United States, because they're not really dollars, they're just bank liabilities. So the banking system solved Triffin's paradox for national authorities. The problem comes in, and they were warned repeatedly by very prominent officials and experts during the time, we're talking about during the 1970s, that you have a monetary system operating outside the purview of any not just the Federal Reserve, any central bank. If that starts to go wrong, there is no way to fix it. And that's essentially what happened in August of 2007. And we haven't been able to get out of that kind of a position. That's where the deflation comes from. You have this global monetary system that broke down in August 2007 and has never been fixed. So the stark warnings that the Federal Reserve officials were given decades ago actually came to fruition. And now we're kind of stuck because the monetary powers that be, the Federal Reserve, doesn't have any idea how to plug back into that system because it didn't stand still. As evolved as it was in the 60s and 70s, it evolved enormously in the 80s and 90s. I'm talking about things like derivatives, currency swaps, interest rate swaps, collateral and repo. I mean, all sorts of really esoteric and complicated monetary forms that, you know, you go back to the 1990s, Alan Greenspan was shrugging his shoulders saying, we can't define money here. What would we do if things go wrong? And the answer is there's nothing you can do. And that's really kind of what defines the structural secular background since August 2000. Where is this deflationary sort of vortex coming from? It's coming from this monetary system outside the United States, the shadow Eurodollar system that, you know, the Federal Reserve just cannot fix.
Ultimately,
yeah, there's a lot to
yeah, there's a lot to it, and
yeah.
this is why I'm interviewing, because I am not an expert on this at all. So, but I'm glad you are, and I'm glad you take the time to look forward and say, okay, this is what's coming. Here's some solutions. So it's common that countries lose reserve status.
Yes, in
Whatever
fact, it's almost inevitable, right, Bruce?
Yeah, it looks like it.
I mean, there's no single reserve. I mean, as I said before, by and large, through history, it's not a single reserve currency. There's usually currency blocks, and so I don't think anybody would be totally surprised if, you know, 10 years down the road, there isn't a single reserve currency either. There's currency blocks and things like that. It wouldn't be totally out of the question. In fact, it would be more reverting to the mean.
And yeah, that's kind of why I just asked that, because it seems like we already have a blended system that's not official.
Oh yeah, I think that's the most misunderstood part, is that the global reserve currency. First of all, I don't think most people, especially Americans, think too much about global reserve currency. Maybe that's the only privilege of the US dollar denomination, is we really don't have to think about the nuts and bolts of it because we don't see its impact. You know, the dollar is our own national currency. So if it moves, it really doesn't impact our daily lives. At least we don't notice it. It really does. When the dollar goes up in value, that's bad for everybody, including Americans. But by and large, I think, you know, outside the United States, there's much more awareness of what the dollar is and what the dollar does, even if there's not specifically, you know, a good handle on what exactly do we need a global reserve currency to do, and how does it actually get done. There's you know, the details, or the plumbing, as people often call it. There's not a lot of literacy about what actually takes place in the global reserve. So it's kind of hard for the public to make sense of all this stuff and think, well, what is really going on here? Money, inflation, deflation, Federal Reserve, quantitative. I mean, all of these things are sort of, you know, up in the clouds and not something that people can really get their hands around, or even their common sense grasp and get some kind of intuitive sense for it.
So if the U.S. was not the sole recognized global currency, you don't feel that would be devastating in a way, because it's almost already in place?
Yeah, what I tell people is that, look, the Eurodollar system broke in August 2007. That's almost 14 years ago. And so we've had a deflationary drag on economic growth that's bad for everybody. So if the Eurodollar US dollar system is replaced tomorrow, and it's replaced by something that actually works, then no, we would not lament losing the reserve status one bit, because we're being harmed by it right now. That's, you know, it's hard to connect those dots, but once you do, you see that the reserve currency system that's in place now is not working. So getting rid of it, we're not losing anything. And if we are losing something, the benefits from replacing it with something that works would far exceed any cost. And that's, I mean, it's not just a strictly monetary small e economic issues. There's, you know, political considerations as well, because authorities like having the idea of the US dollar being the reserve system. So all sorts of complications. But in an ideal world, we should be able to say, look, we fixed the reserve currency regime with some other type of currency that's not the US dollar. That could be a very, very good thing.
Okay. So going forward, you're not as concerned about inflation, but you are concerned about deflation, or is that a concern?
Yes, to me, it's, has anything changed? So we've been in this prolonged period of monetary dysfunction. It isn't, it's like the bond yields moving up and down. It's not a straight line thing. It's not like we've been in a deflationary environment consistently. We go through these cycles where we have a couple of years of, that disinflation, deflation kind of working around the world. And then it backs off and we get reflation. 2010, 2011, for example, we talk about 2014, 2017, part of 2018. We have these reflationary cycles where it looks like, oh, things are getting better. Maybe we've gotten out of it. Where the bond market during those reflationary period tells you, no, things haven't really changed. Some of those deflationary pressures have backed off a little bit, and that creates enough sufficient monetary space that it looks like things are getting better, but it really, nothing has changed underlying the Eurodollar system that continues to be broken. And so when we look at 2020, 2021, the question we're really asking is this kind of like 2017? Are we seeing nothing more than modest reflation that gets boosted into, CPIs that are highest in many, many years through other factors that are not monetary? But by and large, what we really want to ask ourselves is, has the monetary system broken out of its deflationary rut of the last 14 years? And that's where we look through these clues, not just in the bond market, but in all sorts of other markets around the world. And they're telling us, no, yes, we see CPIs going through the roof. We see modest reflationary pressures in a lot of places around the world. However, we haven't seen anything change in the underlying monetary condition. In fact, there's quite a lot that suggests that maybe it's a little bit worse than it was before 2020. We may have actually sustained, this is kind of common sense, but the world economy may have sustained more damage from last year's 2020 recession than we're kind of realizing right now. And if that's the case, that would be even more deflationary or disinflationary than it had been up until that point. And that's where you look at low yields that never really got that high earlier this year in the sell-off, when yields were backing up in January and February across the world. They really didn't go that far, and now they've reversed again. So that's, lower and lower yields, not really much in terms of the reflationary trade. It's a really solid signal that nothing has changed in the monetary background, and we're simply cycling through this period where we go through temporary reflations. And the reflation is simply, it's not quite inflation, but it's not deflation or disinflation either. So it's kind of where prices can go up, oil prices, commodity prices rise, but it doesn't lead to this sort of economic and monetary condition where we're out of the trouble and we're into an actual legitimate economic expansion and growth. We never quite get there. Reflation is always one step short of that.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.
The Norris Group originates and services loans in California and Florida under California DRE License 012-19911, Florida Mortgage Lender License 1577, and NMLS License 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the Hard Money tab.